Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, stocks and bonds have struggled so far this year in 2022. No one likes to lose money, but we can attempt to make the best of a real tough situation. Investors can take advantage of capital losses through tax loss harvesting. Let's discuss what tax loss harvesting is and how people can take advantage of it.
So first, Steve, we're going to discuss this at a high level. There'll be more details involved, but at a high level, just to be clear, tax loss harvesting only works in taxable brokerage accounts, not qualified accounts like IRAs and 401ks. Now, tax loss harvesting involves selling assets you currently are carrying at a loss. You can then use this loss to offset any capital gains you may have realized in the current year. And if you don't have gains to offset in the current year, you can carry those losses forward and use them in future years. And if you don't have any gains to offset in future years, you can utilize up to $3,000 per year to offset ordinary income until that loss is all used up. Because at the end of the day, what we're trying to do here is lower your overall tax bill, which people prefer.
So Travis, with a little bit more detail, so you sell the asset in question to bank the loss. Now you have to decide what to do with the money. You can't buy the same asset back right away, because if you want to buy that particular asset back, you have to wait at least 31 days, because if you buy it back before that 31 days, it is labeled a wash sale, and the IRS will disallow you to capture those losses. Also, if you secretly try to buy the particular asset back you sold in a different account, like an IRA, it doesn't work. The IRS has seen this before, and they still say it's a wash sale, and they will disallow those losses.
So, Steve, we've sold the asset, we've booked the loss, we can't buy it back for 31 days, and now you have this cash. You can hold the cash for 31 days, but as we've seen recently, markets can turn quickly, so you could potentially miss out on a sharp rebound by not being invested.
Yes, instead, Travis, you can find a similar asset class highly correlated to the one that you sold, but not substantially identical as defined by the IRS. This way you get to bank the loss, but you get to stay invested. So you potentially get to participate in any upside in that asset class.
That's right, Steve. And in today's world, there are plenty of other exchange-traded funds, mutual funds, or other tools we can utilize to help facilitate harvesting losses while helping you stay invested. Here at Allen Capital Group, our trade desk routinely combs through our strategies to find opportunities to harvest losses where it makes sense for clients. We think if we can continually do this over time, capital gain taxes will be saved, and that will lead to incremental tax alpha, keeping more money in our hands and less in Uncle Sam.
That's so true, Travis. This has been great. I look forward to it next week.
I look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.